content is a technical analysis on KB Home, a company of the consumer cyclical sector and residential construction here off the daily interval. And one of the most recent evidence supporting the notion that the formidable interest rate increases orchestrated by Fed Chair Jerome Powell, coupled with the surging mortgage rate market, could potentially serve as a catalyst for a substantial correction in the housing market. One of the latest earnings report released by KB Home, one of the largest components to the home building sector within the entire country. Within the report, a particular aspect grabbed a lot of attention, namely the remarkable escalation witnessed in the buyer cancellation rates during the fourth quarter. The rate experienced an unprecedented surge, reaching a staggering 68% cancellation rate, significantly surpassing the 35% recorded in the previous quarter and even eclipsing the 13% recorded during the fourth quarter of 2021. The figure exceeded the cancellations observed during the darkest period of the 2008 housing crisis, where the average cancellation rate stood at approximately 47%. So just a massive gap in between that 68 and 47% buyer cancellation rate there. So a lot of distortion in the market, and now we're starting to get that clearly on the from a technical analysis perspective here off the daily interval, where we've put in a nice clean divergent high with off this rising bearish wedge pattern, and we've snapped it. We ended up snapping it, we ended up back testing it, and here we are. We ended up closing solidly below it off this primary reactionary low trend line, right off the March 2023 reactionary lows there. Multiple reactionary lows to help strengthen its validation, and where we are at a key pivotal inflection point with negative and bearish divergences constructed and established, confirmed on all three momentum technical indicators, what they confirmed crossovers on the moving average convergences and oscillators here, where you've actually had a nice solid red candle close below the zero line threshold of the oscillator histogram there. So just a key pivotal inflection point. Bull traders, dip buyers, they need to step in right now. They need to step right here off the snapback counter trend rally and present this as a false breakdown. And there is nothing more bullish than a false breakdown. Short traders, bear traders, they want to say continued sell-off event, if not a nice clean back test this primary uptrend line, and then maybe a sell-off right into the 618 Fibs retracement, call it 42.35 price support for a 7.2% crash, which will coincide with the 50 exponential moving average there. Undercut those moving averages down to 40.76 for a 10.5% crash, down to 39.86 for a 12.7% crash, and on down to 38.82 for the 50% Fibs retracement there for a 15% crash, down to 36.87 for a 19.3% crash, and then onto the 382 Fibs retracement, called 35.65 price support for a 21% crash, which will more than closely correlate with the 200-day moving averages hovering down below there. And if we undercut that there, we'll have a complete backfill the gap for a 25% crash there. A strong gap support there right in the middle between the 236 Fibs retracement and the 382 Fibs retracement. So just a massive inflection point. If we take that out, then I would only suspect a waterfall like selling event, forced liquidations, margin calls, stops to go off, and just a renewed sell-off phase down below there. And I'll take us out to the much larger picture here off the monthly interval, and we have this primary reactionary low trend line off the 2011 reactionary lows, multiple reactionary lows that have strengthened its multitude of validation there, and then here we are at a key inflection point off the reactionary primary downtrend line off the 2005 September reactionary highs there, right before the great financial crisis, which resulted in this massive flashlight type of event, a huge housing market correction there, which was good for a 94% crash there, where it really briefly touched $5 a share there. So again, just a massive inflection point where we've built up this consolidation phase going off that 2011 reactionary low trend line, and here we are, just briefly briefly back testing and rejecting right amongst it. Came back up and got rejected once again, and off of 2022, January of 2022, ended up rejecting that too. Came right back to the 50 monthly moving average, broke down briefly below it, back tested it, and hit that 25.38 price support. The support level 25.38 will kind of mark that down actually. 2538. I'll color code it tan. And yeah, there it is. That's one of the big support lines that you'll get there, and which was heavily defended here off the 2022 flash crash there. So we'll see what happens. Ended up putting that double bottom in off of October there, and ended up going right back up to some pretty sizable gains for 76% in gains there. So we'll see what happens. Trace it right back here, and again, here we are now, right at a generational reactionary high primary down trend line resistance, and this is it right here. This is a big deal, just a multi-decade psychological resistance inflection point there, and I would only suspect some sort of reaction, as we've already gotten pretty darn close to that. We've already had that nice clean back test and rejection, and here we are potentially putting in a sell signal here off the daily interval.